Assalamu alaikum. Welcome back to the class and lecture number 30. And we are still talking about bonds. Bonds like as in fixed income securities. And we talked about measuring bond volatilities with duration. And there were important considerations that we looked at when we were looking at durations while measuring bond volatilities, in which we wondered and we discussed that it is a measure that is needed for the accounts for both size and timings of cash flows. And of course, we did also talk that maturity is an inadequate measure of volatility, and it may not have an identical economic lifetime. We also talked about different factors affecting volatilities and what actually was different between maturity and duration. That is what we talked about in our previous lecture. Just to remind you, what is duration? And duration is a measure of a bond's lifetime stated in years that accounts for the entire pattern, both size and timings of cash flows over time and life of the bond. Also, it is the weighted average maturity of a bond's cash flow, and weights are determined by present values of cash flows. That is what we talked in length about what actually is duration. And I need not emphasize once again that it is very different from maturity. That has to always be kept in the back of your mind when we're talking about maturities and duration. So, duration is a measure of the effective maturity of a bond. Once again, duration is the effective measure of the maturity of a bond. Since the measurement of duration considers the timing and value of intermediate payments, it is important that it is an accurate measure of average life and is more meaningful than maturity for any bond is or has any coupon payments. We remember talk that duration is shorter for bonds with coupons, and duration is equal to the maturity time of zero coupon bonds. So then why is duration an important function? Why do we have to worry about duration? Because it allows comparison of effective lives of bonds that differ in maturity coupons. That's very important. Also, it is used in bond management strategies, particularly immunization. It is also important because it measures bond price sensitivity to interest rate movements, and which is very important in any bond analysis. This is important for us to understand that it measures price bond sensitivity to interest rate movements and is used as an important factor in bond price management and the prices. So then what is the difference, or what is the relationship between price and duration? Do you still remember that we said that price change is proportional to duration and not to maturity? Keep it in the focus. Maturity and duration are two different things. So, is one of the key properties of duration is related to price changes. The concept of modified duration is used extensively in the industry. Duration incorporates both the coupon rate and maturity effects into a single measure. This is what we talked about. This was what we talked about when we talked about the relationship of a bond and its relationship between duration and price. So, duration is an average signifying point in time when the price volatility of a security is repaid, and it is a measure of the price sensitivity of a security to interest rate changes. That is the significance of duration, that it measures price sensitivity. It measures price sensitivity of a security in relationship to the interest rate changes. It is important. It also signifies any given period of time in which security has to be repaid. That is what duration is going to be looked at when we talk about durations as being important in analyzing bonds and bond prices. Because until we are able to understand and comprehend the value of duration, we will not be able to understand bond analysis and bond management. So, a duration is a measure of the effective maturity of a bond. The duration is measuring the maturity periods of a bond. Also, it is a weighted average of the times until each payment is received. Remember, once again, shorter than the maturity period, except zero coupon bonds, because you got nothing to do with interest rates, because you've got a first-hand discounted value of an zero coupon bond, because you bought it at a discounted value when it was first issued. So, the duration for zero coupon bonds is the same as the maturity period for a zero coupon bond. That is the basic difference between zero coupon bond durations and coupon bond durations. The difference between maturities. This is important. And this is what we talk. Now, why do we have duration? Why do we need to study durations? What is the use of the duration in the valuations of bonds? Why must we study bonds? Why must we study duration? Why must we look at yield to maturity? And why must we look at the issues related to durations and maturity? So, these have to be understood in relation to our bond analysis and bond management. So, duration is the weighted average of times when each or until each payment is received with the weights proportional to the present value of the payment. That is what duration is all, because that would be an effective way of evaluating the maturity levels of a bond. Now, obviously, one of the important things that we discussed was that it is a measure of interest rate risks that considers the effects of both the coupon rate and maturity changes in bond prices. That is one of the most paramount reasons that you look at duration. You look at it by matching the duration of their firm's assets, the firm that has issued the bond. So, by matching the duration of their assets and liabilities, the bond managers or the fund managers or the managers of financial institutions can minimize exposure to interest rate risk. This is very significant. Since we're talking about profits, since we're talking about growth in investments, since we're talking about also being away from all sorts of risk, and we had talked about default risk, and we had talked about interest rate risk, and we needed reasons to understand why we need to avoid default rate risk and why, or default and payment risk, and risk that has to be avoided, something called like the interest rate risk. Now, what happens is, we must understand that duration is the study, or duration is the figure that we need to look at when we're talking about being able to measure interest rate risk, and by looking at duration, we'll be able to avoid the effect of interest rate risk on our realized rates of return or realized real rates of interest that we actually will eventually be getting. Some of the uses were discussed in the previous lectures. Some of the uses would have to be re-narrated to you because this is important. It is important for us to use that a duration is used as a buffer or an immunization to any kinds of interest rate risk, because we've locked in our trades, we've locked in our investments, we locked in our interest payments for a considerable period of time, and that way we've locked in all the values of the cash flows. because that's precisely we shall be getting when we're talking about returns on investments, because you will precisely know what returns are you going to get over a period of time and what is going to be the amount of the interest or the returns on that particular period of time divided in coupon rates. So you get yourself immunized because of the use of duration from interest rate risk, and is a tool that is considerably used for passive management. Okay, another word has just cropped up, is passive management. But we'll talk about this probably at the end of the lecture, how different strategies can be used in using the bond management. For now, we'll be focusing more on the financial institution and how they look at the investment strategies which are related to bond management. So one of them was looking at the duration aspect, which is immunization that keeps us away from all sorts of interest rate risk. Now, the financial institutions use this concept for using it as a tool for managing assets and liabilities, the interest rate. Remember, interest rate is one of the more significant aspects in making or breaking any company's balance sheets, because it is going to be a considerable part of your financial distribution as far as your expenses are concerned, will definitely be more focused on interest rate. Even a fractional decimal point change in an interest rate hike will affect your profitabilities. On the other hand, if there is a decline in interest rates, will definitely increase your profitabilities and make your balance sheets more healthy looking. So the target date immunization can be used to lock a fixed rate of return. When you know about the dates, you can use this immunization, this duration, to lock in all the trades. Now, if we were to look at one of the examples of how we can talk about the duration, if you look at one problem, let's say there is $100 par value of a bond with a 6% coupon rate for 5 years. So we have a bond which has a face value of $100 with a 6% coupon rate and has a maturity of 5 years. When we're talking about 5 years, we're technically also talking about a 10 semi-annual payment procedure, because you have 6 monthly payments. So if in 5 years you'll have a 10 monthly period, and then you'll have payments of 3% each 6 months. It's a 6% coupon rate, and if you're going to have biannual payments or 6 monthly twice a year payments, you'll be paying out around 3%, or you'll be receiving, if you bought the bond, 3% every 6 months in 8% market with a 4% semi-annual yield. You'll have a gain or a loss. Looking at the slide right now on your computers or on your TV screens, you are able to understand that you have 10 different figures from figure 1 to figure 10 with a payment coupon rate of 3% or $3, because it's a 6% would be $6. And then if you look at the price volatility of cash flows or the net price value of the cash flows, you find that there's a certain amount of rate. Depending on compounding, you'll get a return of 698. But you have a look at the slide and you'll be able to understand. If you were to look in detail at this problem, that it's a set problem of a $100 par value with a 6% coupon rate with a 2 yearly payments of 3% each or $3 each. In this case, you'll have value of 3% every 6 months, 6% every year. You'll probably make around 801% on return in several years based on different values. So if you focus and look and try to work on this problem, these two slides will help you understand what I was talking about, duration and the effect of compound growth or reinvestment into the bonds. Because remember, when we talk about bonds, we're not talking about simple interest, we're talking about compound interest, because of the fact that you'll be probably be considered to be reinvesting all the returns that you're getting every monthly or semi-annually back into the bond for you to get a better return, which would be much better than the 6% you'll actually be perceiving on getting on the bonds. Now, these two slides that you should be looking at while we are doing the topic of bond valuations and the durations effect on returns on investments in the bond. This will help you understand how these are going to help you understand the effect of duration in comparison to maturity. So, the effect of maturity is different. In 5 years, with 10 semi-annual payments, you'll be able to get a figure which is 801.5757/91.8927, which is equal to 8.7229 years. Per 4.36 years, that's what you'll get. So durations, so the 5-year 6% coupon security has a duration of 4.36 years in actuality, where expected yield to maturity is 8%. So solve this problem, look at this problem. I'll give you a hint. The hint is it's not the same as when I is equal to 8%, and then you try to figure out this problem on your computers or on your papers, and then you'll be able to understand that there is a modified duration. We were talking about two terms of 5 years and 4 years with an 8% and a 6% maturity interest rate, and you'll be able to find a modified duration is equal to duration, which is 1 plus I, and remember I is equal to 8%. No, that's the hint I'm giving you. You'll be able to understand this problem more when you actually do this problem. One of the better things of trying to work out and understand situations like durations, situations like bond price relationship, it will be a good idea for you as students to practice problem sets as much as you can, and you would by now be knowing and be looking at the handouts or to the recommended books. In fact, 2 recommended books, excellent books that you'll be able to look at and find more details on how to solve problems and work out and do your homeworks on the problem sets, and that is the way that you'll understand these issues more. Now, there are rules for duration. In understanding durations, you have to also understand that certain rules for durations or certain principles or set standards for duration. One of them is that the duration of a zero coupon bond equals to its time to maturity. But this is sort of, hammering it again and again into your minds. This has been repeated several times by me, that you must understand. Do not confuse rule number 1, and that is the duration of a zero coupon bond equals to own time of maturity. The maturity and duration is the same in a zero coupon bond. That's rule number 1 that you must understand. And what about rule number 2? Holding maturity constant. If you were to hold maturity as a constant feature and is not variable, then a bond's duration is higher when the coupon rate is lower. This rule number 2 is that if you hold maturity constant, it's a fixed maturity date, then a bond's duration is higher when the coupon rate is lower. It's a relationship between lower coupon rates yielding into higher duration. That is rule number 2. Let's get on to rule number 3. Rule number 3 is, again, holding the coupon rate constant. A bond's duration generally increases with its time to maturity. Confused? Shouldn't be. It's different from rule number 2. Let's get back to rule number 2. Holding maturity constant. Rule number 3. Holding coupon rates constant. We're talking about maturities being constant, and in rule number 3, we're talking about coupon rates being constant. And when you hold coupon rates constant, a bond's duration generally increases with its time to maturity. Rule number 4, we're talking about keeping things constant. We kept maturity levels constant, we kept coupon rates constant. I'm now talking about keeping other factors constant. So holding all other factors constant, the duration of a coupon's bond is higher when the bond's yield to maturity is lower. So these are the 4 rules that you need to understand when you talk about duration. The rules: keeping things constant, keeping maturity constant, keeping coupon rates constant, keeping other factors constant. So these will all give you results which vary. These are the rules that you must understand. Now, what have we concluded from all this? What have we concluded about duration and what actually is duration? So we conclude that to obtain maximum price volatility, investors should choose bonds with the longest duration. Did you get it right? The focus is on duration. The focus is to obtain maximum price volatility, investors should choose bonds with the longest duration. Another conclusion that we can do is that duration is additive. It means that the portfolio duration is just a weighted average. We're not talking about portfolios, we're talking about duration of a bond, which is additive. You keep adding time, you keep adding duration to the maturity of a bond. Also, we must understand that duration measures volatility. Say it again, duration measures volatility, which isn't the only aspect, which isn't the only risk aspect in bonds. But duration does measure volatility, but isn't the only aspect that we are looking at when we're talking about risk in bonds. When we were talking about risks in bonds, did we forget? We talked about the default risk in bonds and the interest rate risk in bonds. These were things that we considered when we were talking about bonds. So we conclude that duration is additive, and to obtain maximum price volatility, investors must choose bonds with the longest duration. And we conclude that duration measures volatility, which isn't the only aspect of risk in bonds. That is what we really gathered from things we've talked about duration. While we were talking about duration, there's another word that we must understand, another phenomena, and that is convexity, from convex. So convexity is very important consideration in the bond market. Convexity is most important consideration in the bond market. The significance of convexity has to be understood. But then, what is convexity? Obviously, the name is derived from the term convex, which is different from a straight line. If you're talking about duration, you're talking about straight lines. If you're talking about maturity, we're talking about a standard feature in maturity. But if you're looking and talking about convexity, we're talking and referring to the degree to which duration changes. The difference or the degree of difference in which duration is changing, and it changes as the yield to maturity. So, convexity refers to the fact that it is the degree to which we can look at the changes in duration, and duration changes as the yield to maturity changes. In similar terms, price-yield relationship is convex, which means there is a degree to which duration changes, which gives us this phenomena that price-yield relationship is convex. Price-yield relationship is not going to be the same every time, and it's going to be different or variable, so price relationship can be claimed to be convex. Duration equation assumes a linear relationship between price and yield, and convexity is largest for low coupons, long maturity bonds, and low yield to maturity. Once again, convexity is largest for low coupon, long maturity bonds and low yield to maturity. That is what convexity is. Convexity refers to duration changes as the yield to maturity changes. Y2M was studied first, is the return of this yield at the time of maturity, and that one expects an investor to be holding on to the bond till the end of the maturity period, which is different. Yield to maturity would then be different from call to maturity. So you must understand that convexity is the duration equation assumes a linear relationship between price and yield. That is what we've understood from the term convexity. Now, if we were to look at the description that we've given, and if we were to look at the slide that shows the pricing error from convexity, we would understand that the price of convexity, as you can look at on your screens, is curved. The duration you will look at will be looking at a curve between price and yield. So the relationship between price and yield is convex, and you can look at the duration not being straight line but showing a curvature, which is a pricing error between price and yield. And you look at the convexity of the duration. You can have a good idea of what convexities are, and they are variable as far as prices and yields are concerned, relationship to the bond price volatility. Once again, we talked about bond prices are inversely related to bond yields. Bond prices and bond yields are inversely related to each other. Also, the price volatility of a long-term bond is greater than that of a short-term bond, once again holding the coupon rates constant. If coupon rates are held constant, if coupon rates are not changed and are not variable or are fixed, then the price volatility will be greater for a long-term bond than that of a short-term bond. By doing what? Holding coupon rates constant. You'll be able to look at the phenomena where the price volatility will be greater for long-term bond. On the other hand, the price volatility of a low coupon bond is greater than that of a high coupon bond holding maturity constant. दोनों चीज़ों में थोड़ा सा कंफ्यूजन है, इसको आप ज़रा से एक दफ़ा क्लियर कर लें. जो पहले मैंने बात की लॉन्ग टर्म बॉन्ड्स पे, उसमें कूपन रेट्स कांस्टेंट थे. जब लो कूपन बॉन्ड की बात कर रहा हूँ तो इसमें मैच्योरिटी कांस्टेंट है. दोनों चीज़ों में बॉन्ड प्राइस वोलेटिलिटी के हवाले से वी मस्ट अंडरस्टैंड द प्राइस वोलेटिलिटी ऑफ अ लो कूपन बॉन्ड इज ग्रेटर देन दैट ऑफ अ हाई कूपन बॉन्ड विद मैच्योरिटी बीइंग कांस्टेंट. जो पहले बात की थी वो ये थी कि द प्राइस वोलेटिलिटी ऑफ अ लॉन्ग टर्म बॉन्ड इज ग्रेटर देन द शॉर्ट टर्म बॉन्ड विद कूपन रेट बीइंग कांस्टेंट. ये दो फर्क थे जब हमने बात की थी बॉन्ड प्राइसेस आर और बीइंग इनवर्सली रिलेटेड टू बॉन्ड यील्ड. तो जिस हम बात कर रहे थे लॉन्ग टर्म बॉन्ड्स की और शॉर्ट टर्म बॉन्ड की, तो लॉन्ग टर्म बॉन्ड्स में हमने कूपन रेट्स को कांस्टेंट की बात की, और जब शॉर्ट टर्म बॉन्ड्स की बात की तो मैच्योरिटी कांस्टेंट की बात की, और प्राइस वोलेटिलिटी की बात की थी कि लॉन्ग टर्म बॉन्ड्स में कौन से ग्रेटर हैं और शॉर्ट टर्म बॉन्ड्स में क्यों ग्रेटर होते हैं. वो इसलिए कि हम मैच्योरिटी को कांस्टेंट अगर रखें तो प्राइस वोलेटिलिटी लो कूपन बॉन्ड्स की भी हाई हो सकती है दैन कंपेयर्ड टू अ हाई कूपन बॉन्ड. ये बॉन्ड प्राइस वोलेटिलिटी के हवाले से आपको समझाने की ज़रूरत थी, जिसमें आप समझ सकें कि क्या उनका आपस में रिलेशनशिप. नाउ इफ वी वर टू लुक एन एग्जांपल ऑफ बॉन्ड volatility. Now we're talking about an example of a bond with a 2-year maturity with 1 year remaining. क्या मतलब हुआ? एक्चुअली मतलब ये हुआ कि हम एक 2 साल के बॉन्ड की टेक्निकली बात नहीं कर रहे, क्योंकि उसमें से 1 साल का पीरियड रह गया. So in effect, what we are talking about is really a 1-year bond. When we talk about a 2-year bond being actually be a 1-year bond and it falling by 9.57%, ये एक प्रॉब्लम सेट है जो मैं आपसे डिस्कस कर रहा हूँ. एक बॉन्ड जो 2 साल का है और उसको हम कंसिडर कर रहे हैं फॉर 1 year पीरियड fell by 9.57% when market yield increased by 5%, 5% से 6% हुई, और 9.57% when the market yield increased from 5 to 6% and rose by 9.71% when market yields fell from 5 to 4%. एक एग्जांपल दिया आपको मैंने उस बॉन्ड की यील्ड का जब 5 से 6% मार्केट इंटरेस्ट रेट बढ़े, और एक जब मार्केट यील्ड फेल डाउन फ्रॉम 5 to 4%. जब आपकी इंक्रीज हुई, the measure of percentage price change is called what? That is what bond volatility is. So the measure of percentage price change is called bond volatility. I hope you understand bond volatility now. Once again, measure of percentage price change is called bond volatility, जिसके लिए मैंने आपको एग्जांपल दिया था of interest market yield increasing or decreasing. So what if we had a bond with 30 years remaining and a 5% coupon and market rates rising to 6%? क्या होगा? Again, assume semi-annual coupon rates of 2.5%. 5 साल का कूपन रेट है तो सेमी एनुअल यील्ड्स में वो 2.5% आपको मिलेगा, 2 दफा मिलेगा, बात वहीं आ जाएगी. तो अगेन assume while thinking about this 30-year bond with a 5% coupon in a market rising to 6%, assume semi-annual coupons of 2.5% when a market semi-annual yield is 3%. You're talking about 5% market yield and 6% market rates and 5% coupon yields. तो इसका effect भी ऐसे ही होगा और इसका result जो निकलेगा, okay, for your convenience, just look at the screen and you will find out how we solve this bond volatility problem. And the screen will tell you that we're looking at a 25 years by 1.03 plus 25, ये चलता जाएगा into a 30-year bond, and then you'll get a result which will be what? So what is going to be the price change? Have a look at the screen. Just look at the screen, look at the numbers. So this is a 30-year bond, and then you'll find that the percentage price change is actually 13.8%. For the same change yield in time from 5 to 6% जब आपकी increase हुई है, the 1-year security जो सबसे पहले बात की थी had a 9.57% change. ये आपको इस slide से थोड़ा सा समझ आएगा, because you'll be able to understand the formulas better when you look at the screen and hear what I'm talking about. So the 30-year security had a 13.8% change in price. We're talking about 30 years, and the 1-year security had a 9.57% change. These sets I need not emphasize once again. तो पहले आपसे बात की थी मैंने ड्यूरेशन के प्रॉब्लम सेट्स की, जिसमें हमने ड्यूरेशंस को डिस्कस किया था, और ये जो हम बॉन्ड वॉलेटिलिटी के लिए प्रॉब्लम सेट्स देख रहे हैं, you'll find a number of these bond volatility sets in your recommended books. The 2 books that we've found to be very useful for you as students will help you go along with understanding duration problems and understanding volatilities of bonds and how price changes take effect when we talk about bond volatility. If you do these over and over again, you'll be able to understand durations and bond volatility is much greater than you would normally understand these issues. Now, what is actually bond price volatility? Bond price volatility is the percentage change in bond price for a given change in yield. That is what we understand by volatilities. एक तो चीज आप जहन में रख लें कि volatility है क्या? Volatility would mean anything moving on both sides of the price. It's not going to be a single directional movement. It can be a directional movement in any given side, depending on changes in market yields or depending on changes in discount rates or depending in changes in interest rate hikes or lows in interest will bring about a change in price volatility of the bond. ये volatility तो खैर आपकी stocks में भी ऐसी होगी, but remember bond volatilities में volatility increases with maturity. ये हम बार बार इसको जिक्र इसलिए करते हैं कि volatility का एक direct relationship है maturity के साथ. और bonds की जब बात होती है एक इनकी fixed maturity है. Stocks की कोई maturity नहीं है. They're infinite. There is no maturity date for a stock, but you have a definite maturity date for a bond. So, when we are talking about volatility, a 1% increase in market yields from 5% gives volatility of what? If it's 1 year with a 9.57% and prices fell to 990.43. If it's 15-year 9.8%, price fell 9.02. If it's a 30-year 13.8%, the price will fall to 861.62. So you'll notice a direct relationship between bond prices and market yields or market interest. And volatility increases with maturity. The longer the period to maturity, the longer take to understanding what bond prices are as far as relationships are concerned. Now, if we were to look at a zero coupon bond, and if we were to understand that maturities and durations are the same in zero coupon bonds, and we do remember we talked about the maturity and the duration being the same in a zero coupon bond. Now this was different than bonds with coupons, जहाँ पे duration कम होती है, maturity ज़्यादा होती है. But in zero coupon bonds, we understood that it's the same. So if we're talking about maturities, or if we're talking about durations, we're talking about the same thing as far as a zero coupon bond is. So if we were to look at price volatility in a zero coupon bond, we would understand. And if you were to look at the problem, मुझे यहाँ पे आपको बार बार जो examples देने पड़ रहे हैं प्रॉब्लम सेट्स की वजह से, तो इसलिए ज़रूरी है कि जो बॉन्ड का एक ऐसा टॉपिक है, बॉन्ड का एक ऐसा लेक्चर है जो आपको बहुत फ्रीक्वेंटली या मोर कॉमनली अंडरस्टैंड करने में ज़रा मुश्किल पड़ेगी. इट्स अ लिटिल बिट डिफरेंट देन ट्राइंग टू अंडरस्टैंड स्टॉक्स और इक्विटीज और शेयर्स. बॉन्ड्स इज अ डिफरेंट थिंग बिकॉज बॉन्ड्स इज ऑलवेज फिक्स्ड. तो बॉन्ड की वॉलेटिलिटी को समझने के लिए आई नीडेड टू गिव यू मोर एंड मोर एग्जांपल्स from problems, and I'll keep requesting you do your own homework and do your own problem set solving procedures again and again to understand duration, bond price volatility and yield to maturity. ये सारे समझेंगे तब जब आपने equations देखे होंगे. We had a lot of equations on yield to maturity and yield to call और duration जो पिछले लेक्चर में भी बात हुई थी, ज़्यादा इस लेक्चर में भी बात कर रहा हूँ. You'll be able to understand duration and price bond volatility more by practicing problem sets. जैसे कि ये अब आपको मैंने एग्जांपल दिया था, looking at how the volatility of a 30-year zero coupon bond, if market rate changes or increases from 5% to 6%, तो क्या उसका होगा, और अगर वो गिर रहा है तो फिर क्या रिजल्ट होगा for a 30-year coupon bond. So you look at that lower coupon bonds have more volatility. ये सबसे पहले हमने डिस्कस किया था कि जितना कम होगा आपका कूपन का यील्ड या कूपन रेट, वॉलेटिलिटी भी उसी तरह बढ़ेगी. दैट इज व्हाट वी फाइंड व्हेन वी टॉकिंग अबाउट लॉन्गर टर्म बॉन्ड्स. सो वी मस्ट अंडरस्टैंड ऑल दिस व्हेन वी टॉक अबाउट बॉन्ड वॉलेटिलिटीज. अब ये हमने बॉन्ड जो वॉलेटिलिटीज की बात की और हमने ड्यूरेशंस की बात की. व्हाट एक्चुअली डिड वी गैदर फ्रॉम ऑल दिस? So if we were to, summarize all this, we would understand that we found a lot of things, that bond prices are inversely related to bond yields. Bond yields or bond prices की एक inverse relationship है. जैसे ही change yields में आएगी, वैसे ही prices में आएगी. There is an inverse relationship between bond prices and bond yields. We also gathered from this that the price volatility of a longer maturity security is larger, and it's longer in larger की जो price volatility, इसको भी हमने जब study किया तो हमने देखा कि the price volatility of a longer maturity security is larger than that of a shorter maturity security. Holding the coupon rate constant, confusions नहीं करने हैं आपने, बार बार ये चीज़ें आएंगी. एक जगह आपने coupon rates को constant जहन में रखना है, दूसरी जगह को हम maturity period को constant रखेंगे. इस वक्त जो मैं बात कर रहा हूँ price volatility का, तो ये है कि price volatility of a longer maturity security is larger than that of a shorter maturity security holding the coupon rate constant. हमने सीखा कि price volatility of a low coupon security is larger than that of a high coupon security provided what? Provided we hold maturity constant. So, low coupon security की volatility price को हम consider करते हैं larger when we consider maturity constant. एक और चीज़ हमने discuss की थी, that is the interest rate risk, IRR. वैसे तो internal rate of return भी होता है ये, but यहाँ पे is the interest rate risk, IRR, occurs when realized return doesn't. So, interest rate risk आ जाएगी when realized return doesn't. Yield to maturity की बात हो रही है. जब आप maturity तक किसी चीज़ को hold नहीं करेंगे, there will be no returns. So why does this happen? ये अब आपने सोचना है. और how does it happen? ये भी आपने सोचना. Think about it. Think इसका क्या हो सकता है. So price volatility जो है bond की, वो किस चीज़ पे depend करती है? What does the price volatility of a bond depend on? मैं आपको बता देता हूँ. It is maturity, coupon and yield to maturity. यही तो अभी हमने conclude किया. So, the price volatility of a bond depends on number one, maturity, number two, coupon rates, and number three, Y2M or yield to maturity. Coupon is the yield, maturity is the time between the issuing and the completion of the bond, और ये तीनों ही चीज़ आपकी price volatility के ऊपर इसका असर होता है, and this is what the price volatility of a bond depends on. And this was important for us to understand कि ये क्या सारा phenomena था इस price volatility. Now, if we were to understand, think about approximate percentage change in price of a bond. The approximate percentage change in a price of bond, we would do that, and to get an approximate percentage change in the price of bond for a change in yield, we just multiply it by the change in yield. फिर सोचें, फिर देखें, फिर समझें, how do we get an approximate percentage change in the price of a bond? We do that simply by multiplying the change in yield, and you will get an approximate percentage change in the price of bond. जब yield change होगी, और हमने बात की कि yield और bond की price inversely related हैं, तो जो भी change yield में आएगा, उससे आपको bond price की approximate percentage change पता चल जाएगी. Simply by multiplying it by the change in yield. The change है, not the total figure, just the change. And we multiply it, get a figure by multiplying the change in yield. This is a linear approximation, which is good for small change in interest rate. छोटी changes जो आती हैं, और generally speaking, life में बहुत बड़ी dramatic changes नहीं आती हैं as far as yields are concerned. बड़ी changes आएंगी तो there'll be a chaos. You don't have percentage changes all of a sudden like 5-10%. It's very fractional. And it is the fractional or decimal changes that make all the difference, because it's just a drop in the ocean. And remember, these drops build up the ocean. It brings about dramatic changes eventually by the effect of compounding. So, to get approximate percentage change in the price of a bond, all we need to do is multiply it by the change in yield. And remember, this is a linear approximation. It is good for small changes in interest rates. These are the small changes in interest rates that bring about bigger changes in yields as well. Because we're talking about bond volatility and we're talking about relationship between maturities and yields into the bond prices. Now, जब ये सारी मैंने आपसे बातें की, मेरे जहन में जो चीज़ थी, वो basically was because remember, this is subject of investment analysis and portfolio management. Now, जब investment analysis की बात हो रही थी, तो पहले हमने बात की थी stocks की, जिसमें हमने fundamental और technical analysis किया, और जब हम portfolio की बात कर रहे हैं, तो पोर्टफोलियो में सिर्फ हमने स्टॉक्स नहीं डालने होते, उसमें बॉन्ड्स भी डाल सकते हैं. हम सिर्फ स्टॉक्स का भी कोई पोर्टफोलियो बना सकते हैं, हम सिर्फ बॉन्ड्स का भी कोई पोर्टफोलियो बना सकते हैं. इट ऑल डिपेंड्स on what sort of portfolio you want to build up. Now, when you are building up on a portfolio, you can diversify because remember, the name of the game is diversification. That's why portfolios are made. But there is no stopping you from making a simple kind of a portfolio which would maybe have just stocks, of course stocks of a diversified nature. तो जब stocks की हमने बात की थी, तो हमने बात की थी stocks of maybe value or stocks of maybe a growth model or maybe a blend of growth and value stocks combined together to build up a portfolio. But that was not the end of it. What needed to be understood was that with stocks, you could also combine bonds as a matter of being part of or products of the portfolio. उस हवाले से फिर हमने ये बॉन्ड्स ये लेक्चर्स को डिस्कस किया कि स्टॉक्स की वैल्यूएशंस आपने अर्निंग पर शेयर से कर ली, प्राइस अर्निंग रेशियो से कर ली, यील्ड से कर ली. तो बॉन्ड्स में क्या किया? तो बॉन्ड्स में हमने बॉन्ड्स की वैल्यूएशंस के लिए और बॉन्ड्स के रिस्क फैक्टर्स को वैल्यूएट करने के लिए हमने देखा कि यील्ड टू मैच्योरिटी का फैक्टर, हमने देखा कि डिफॉल्ट रिस्क को कैसे अवॉइड कर सकते हैं, या हम देखें कि इंटरेस्ट रेट रिस्क से किस तरह इम्यूनाइज हो सकते हैं, कन्वेक्सिटी का कैसे हम देख सकते हैं अच्छाई या बुराई को, या हम कौन सी स्ट्रैटेजीज इवॉल्व कर सकते हैं एंड लुकिंग एट द बॉन्ड्स. So bonds, while we were talking about bonds, this is what we gathered. This is an important ingredient of a portfolio that is diversified. And what did we talk about in bonds? We talked about important things like the coupon rate of a bond. Very significant aspect of a bond and evaluating what a bond quality is. So we looked at coupon rates. And then we were talking about bonds. We talked about bonds with coupons and zero coupon bonds. Then we needed to understand yield and the time to maturity. So maturity period of a bond and the yield of a bond were two aspects that we need to understand when we talk about bonds. Also, what we need to remember in bonds is the fact that we must understand the term duration. We also need to understand convexity. And we understand by the previous lectures all about price volatility and the relationship between bond yields and price. The effect of different maturities and the effect of different coupon rates on bonds. These are the things we must understand when we decide what sort of a bond we need to get into, because we're talking about fixed income securities, which is a little bit different than non-fixed income securities. और वो क्या थे? वो equities थी. So when we'll be talking about basic strategies about whether we want to go into for maybe any sort of a fixed income, there is a basic decision that needs to be looked at when we talk about fixed income securities. And what is all that about? That is whether you want to go and make a management decision for an active strategy for fixed income or a passive strategy for a fixed income. Basic criteria kya hai? The basic bottom line is that we need to secure superior returns from the fixed income portfolio. That is the bottom line. Chahe wo active hai ya passive hai, the bottom line is to secure maximum gains, secure maximum superior returns from fixed income securities. Thank you very much.